Welcome. It's Mike Rasmussen, CPA Straight Talk for small business on, what do we got? Must be a Wednesday and September 2nd. So we missed a little tornado yesterday. Well, at least a threat of a tornado. So I was actually on the road, avoided it. So it was great. I was up north, up in what's a place called Branson, Missouri, traveled south about 3 hours and was kind of outrunning a high pressure system that was a squall that was coming through. So I'm glad to be back here. So here we go. And what do we got today is I'm going to be talking about what's called Internal Revenue Code, Section 179. It's like, what is all the hubbaloo about this and how does it impact you, and some great sites to go to. So again, I'm hoping to teach you how to fish, just not spoon feed you. But if you're listening to this and you're on the road, you can obviously listen along and then go to the site later. Go watch the video later at the end of the day, wherever and you can actually see the sites that I'm talking about. But I want to, what Section 179 is a tool that was really modified with the Tax Cuts and Jobs Act. And then there was on allowing additional expensing of equipment. And then I'm going to walk you through how you can actually do if you were to acquire assets, whether new or used. But again, I'll keep it short for you. Again, this is more of just a general information, where to go, and there's a great couple sites to go to. So where this is you want to obviously start out at the IRS. And the IRS, the official website here, and there's a whole section on issuing guidance on Section 179 expenses and Section 168G. What that is depreciation under the Tax Cut and Jobs Acts. Now, so let's just get into, and just a little definition here. Section 179 allows taxpayers to deduct the cost of certain property as an expense when the property is placed in service. So with this new, it increased the 179 expense deduction from $500,000 to $1 million, and then the phase-out limitation increased from 2 to 2.5 million, and these amounts are indexed, and you will see here shortly of what it is for the year 2020. Now, in this revenue procedure that is talked about here called 2019-08, that is guidance with specifically related to changing the qualified improvement property and the definition therein, and I'll walk you through that too in a few minutes. But suffice it to say, it increased the amounts for the Section 179 deduction. Now, so and then let me walk you through real quick. The new law expands the definition of property to allow taxpayers to elect to include the following improvements made to non-residential real, so commercial but non-residential real, and here it is, which means any improvement to a building's interior. However, improvements do not qualify if they are attributable to the enlargement of the building, any elevator, escalator, or the internal structural framework of the building, roofs, HVAC, fire. These changes apply to property placed in service after December 31, 17. Now, I'm going to jump up to the CARES Act made a further modification. So let me jump that up to you. And what is qualified leasehold improvement property? So what would that mean? That would basically be for you're a restaurant or you bought a manufacturing facility and you enhanced what are normally real property, but they're improvements. This is basically defining what a qualified leasehold improvement property means. And why is that important? It's because you can take accelerate bonus depreciation and potentially Section 179 depreciation on those amounts. And so this article right here talks about the new rules in the CARES Act, modifies the depreciable life of assets falling under this category from 39 to 15 years, which makes QIP, which is short for Qualified Improvement Property, eligible for bonus depreciation and Section 179. So this was a clarification that was missed in the Tax Cut and Jobs Act, and now it's actually we're able to now to use bonus depreciation and Section 179. So I want to say Section 179 is different than bonus depreciation. So Section 179 is actually comes first, and you can only take Section 179 if you and truly have taxable income for that entity. So you cannot take 179 that reduces the taxable income of an entity below zero. So what most people will do first is most taxpayers will actually take bonus depreciation first, which is right here, which is called first year bonus depreciation. Okay, and that's 100% expensing, whether you have income or not. It's just 100% expensive, as long as right here's some of the definitions for it. Was expanded to, and the definition here of bonus depreciation was expanded to include qualified property acquired after September 27th if all the following factors apply. So right here, the taxpayer or its didn't use the property any time before acquiring. That makes sense. The taxpayer didn't acquire from a related party. That's important on the related party rules, because that would disallow you to use, you just can't take a related party company, which is basically, the rules are, if you own a brother sister company more than 50%, you wouldn't be able to take that. The taxpayer didn't acquire the property from a component member of a control group. Control group is 80% or more of the voting of the stock. Many more details, but just in brief, if you actually got a hold of me, I could walk you through the details for that. A little bit more, but that is the bottom line with bonus. So 179, Section 170 property is literally a definition, and then you can take bonus depreciation on that qualifying property, and then that's 100% business after, here it is, September 27th of 17. So these are the basic rules. Now, you want to actually go on a site. So here is a site called section179.org, and a very simple. Now by drilling down, I can see it's a finance company that is putting this tool and promoting this .org site, to help you go qualified, when you start clicking on some of the links for qualified financing. But the face of this .org site, Section 179, is very good. So in real simple terms, here it is. The Section 179 deduction for 2020 is $1,040,000, means U.S. companies can deduct the full price of qualified equipment purchases up to that amount, with a total equipment purchase of $2,590,000. Deduction includes both new and used qualified equipment. Now, if it's new to you, that's what qualifies. So it can be new, could be used, but if it's new to you as the tax-paying entity, that's what qualifies. In addition, businesses can take advantage of 100% bonus depreciation on both new and used equipment for the entirety of 2020. Now, so whether you take 179 is limited to obviously the $1,040,000, okay? And then bonus does not have a limit as long as it was qualifying property. So there's also a little calculator this section179.org has, and I clicked on it real quick. Now again, I understand this. I'm not partial to Crest Capital, whoever that is, but I thought that was really pretty simple here. And here is, enter the cost of the equipment here. Now, let's just say that I had a couple $100,000 of equipment that was new to me. I would basically go and then the tax bracket, you can actually put your tax bracket in here. So if I put 21%, I could show the savings. So what it's calculating is a Section 179 deduction is available here for and the for the total amount 179 because it's below the $1,040,000, and then the cash savings was the 21% time. So you can play with this little calculator here. So when what it's getting you down to is the lower the cost of your equipment. Use a calculator just to see. Now I know this is a promotional tool by Crest Capital, but just wanted to show you, if we actually put the amount here of 2 million and show your savings, what you can see is you can see the 179 is $1 million, but then also, and again, this was for 2020, and then you got the bonus. So although you might be limited, actually in 2020 this is $1,040,000, and then the bonus would be the rest. So you take the 179 first on the qualifying property, and then you move into bonus depreciation. Okay, all right. So that's a little bit of just a real basic calculator that you can use, and again, the limit for 179 on qualifying property is $1,040,000 because it was an index for inflation. So that is how 179 works. Okay, then you can get into I want to get into the Form 894. And what this is if you're purchasing assets. So if you're doing an asset purchase of a business, if you will, you, the buyer and the seller, have to actually complete what's called an asset acquisition statement, Form 8594. Why is that important? You, as buyer and sellers, when you do your agreement between the two of you, you have to segregate out the cost. You have to allocate out between Class 1 and through Class 7. So 1, 2, 3, 4, 5, and then 6 and 7. And the reason why you're doing that is that both this form is attached to the buyer and it's attached to the seller, so that you're depreciating, especially on the buyer side. It's showing the total purchase price, but it's also showing the allocation, so that you're going to be able to take Section 179 on assets classified in Class 5. What is a Class 5 asset on this asset acquisition statement? So let's just go to the rules real quick, and I'm just going to walk you through where Class 1 is cash. Class 2 has to do with another personal property. Class 3 assets are market to market, which is basically debt or contingent debt receivable. Class 4 are stock, some stock that you may have property held for the taxpayer for sale to customers. And here we go. Class 5 assets are assets that are not 1, 2, 3, 4 or 6 and 7. What are 6 and 7? 6 are assets of intangibles, and then 7 is goodwill. So you paid over, you allocated out. Here's what the book value, or whatever the value you assigned all the other assets. The leftover is going to be your goodwill. So the Class 5 assets are basically furniture, fixtures, buildings, land, vehicles, and equipment, which constitute all or part of a trade or business, are generally the Class 5 assets. So that is why when you treat this amount right here, which is a Class 5 on an asset acquisition, if you were to buy a business that had existing equipment because it's new to you, or you then, part of your purchase price, you go buy additional equipment, all of that equipment under $1,040,000 for 2020 would be a write-off. Now, you can't 179 take 179 depreciation and reduce it below zero, but you can use bonus depreciation. So if you're in a first year and you're incurring a loss, you're more than likely going to use bonus depreciation for those amount as opposed to Section 179. Okay? So if this is unclear, you can go to 179.org and or a couple places. You can go to the IRS website and look at it, or you can go to 179.org. I wanted to point out the Form 8594, which is an asset acquisition statement. Again, if you were a buyer or a seller of assets, you have to classify those in, and they should agree to your your escrow documents when you're going through escrow, and you want to make sure, because as a buyer, you want a large number because you can write off faster. You can qualify the property as class 5, and you can write off quicker if you were able to bonus or section 179 those amounts allocated class 5 versus class 6 and 7, which are normally written off on a monthly basis, straight line basis over 15 years, intangibles or goodwill. I'll say that again. If you're a buyer, you want to increase the amount that's allocated to class 5 as much as you can, based on net book value, fair market value of the assets that you're buying. You want to increase that amount because you will get the write-off. If you're a seller, you are looking at really who pays the sales tax, and because that property is increased, it increases your potential state sales tax. You're going to have to, sometimes the seller is going to want to reduce the class 5. So there is this asset acquisition statement. Takeaway from this is that it's important on section 179 bonus depreciation and buyers and sellers on what amount that you're allocating on your escrow statement when you buy a group of assets or a business, or you sell a group of assets or a business. This return, because it's attached to the entity return for both buyer and seller. Okay, so that should get us to section 179. What is it? Furniture, fixtures, equipment. Just a whole list of items. In fact, what I'm going to do is take you back to the section 179 org, and what does it actually, what is it? And let me just go through here, and let me get you to, we've talked about the limit right there, and then that we talked about the bonus depreciation. And let me just get back to the home page a little bit here. And how can it save? What I was going to do is just walk you through some of the how it works. And you're talking about what types of items are they, other than the limits. So what it is furniture, fixtures, equipment, items that you would normally have a useful life. What we say is a 3, 5, 7 year period, and there's a whole description of assets that qualify on the site here that you can look for. Okay, all right. So I'm going to come back. Let me sum it up. There is section 179 is from the Internal Revenue Code that basically allows qualified asset to be written off, what we call depreciated, an amount normally quicker than the normal useful life of that asset. So each asset is categorized. It can go 3, 5, 7 year product. Every asset is classified by life in years. There is a depreciation method which ratably, like a maker's depreciation method, that writes that mandates you to write that over a certain percentage over the life of that 5 years. There's a bunching up in the beginning if you're using makers, and if you're straight line, it's ratably over 5 years. Section 179 is taking that total cost and allowing you to accelerate and write off 100% of it in the first year, subject to a taxable income limitation. That's what Section 179 is. So it is allowing the normal depreciation method to expense the cost of a asset that you've placed in business. It's allowing you to accelerate that, subject to a few limitations in the year that you purchased the asset, and versus using the depreciation methods which are allowed for a asset to be expensed ratably over the life of an asset. Okay, there you go. So that's Section 179. A few materials to actually go visit. And Mike Rasmussen, CPA Straight Talk for Small Business. Hope that helped. Take a look at the video afterwards. See the sites that I looked at. Make sure you go to our Facebook page and like. Make sure you go to the YouTube channel and subscribe, if you will. Again, it helps us on the analytics so more people can get this information, which is timely right now as people are remodeling and say restaurants and retail are purchasing possibly new and cheaper equipment as other businesses are going out. So this is a potential. Well, when you've redone your business plan, you have your businesses are out acquiring assets and can use some of these methods. Whether if you're going to have taxable income for the year or not, whether you would use a Section 179 of the bonus depreciation. Okay? Mike Rasmussen, CPA Straight Talk for Small Business on Tuesday, September 2nd, or Wednesday, September 2nd.